Are you making these tax mistakes that is draining your pocket? In this video, I will be highlighting 5 tax mistakes that could be costing you a lot of money. If this is your first time here, my name is Amma, a chartered accountant and a tax professional from AB & Co Accounting and Tax Services. On this channel, we cover topics around legal ways you can use to reduce your tax, how to manage your finances in a way that will help you keep more of your hard-earned money in your pocket, and accounting in general. The first tax mistake that you could be making is assuming that you are no more self-employed, and so self-assessment is not a requirement for you. If you are no more self-employed, and that is the only reason why you were completing self-assessment and submitting a tax return, then if your self-employment has ended on your last tax return, you need to enter the end date for the self-employment. This will tell HMRC that your self-employment has ended, and they will close your tax return records and will not open any subsequent tax returns if your situation doesn't change. If you don't enter the end date, HMRC will not know that your self-employment has ended, and they will issue subsequent tax returns. If you fail to submit tax return for subsequent tax years, you may incur a minimum of £100 penalty. This is how you will lose money to the taxman. This is the first one. Again, if you are thinking that you are no more self-employed and so you don't need to complete a self-assessment, that may be wrong if you meet other criteria requiring you to complete a self-assessment. So you need to check if you meet any other criteria that requires you to complete a tax return. This is the first mistake. The next tax mistake that you could be making is, but before then, if you have found any value at all in this video, please send us a signal by hitting the like button. Also, subscribe to our channel for more tips on tax savings. Again, share this video with friends and family who may find it useful. The second tax mistake that you could be making is ending self-employment business without claiming trading losses that occurred in the year that the self-employment business ended. If you ended the self-employment business with a trading loss, you can claim what is called a terminal loss relief, which is basically carrying back the loss to the previous 3 tax years on a LIFO basis against trading profit of the same business. LIFO basis means last in, first out. You can carry back the trading loss against previous 3 tax years trading profit of the same business on the LIFO basis. Because previous years you may have already paid your tax, carrying back the loss can generate a tax refund for you. You don't want to miss that, and so this is essential that you claim your trading losses against previous 3 tax years if your self-employment business has ended. Again, you can claim the loss against the current year's other income such as employment income. That can also generate a tax refund for you. It's important to consider this. This is technical, and it's a place that you will start to look for an accountant to handle for you. If you want to work with us, please contact us using the details in the description, or hire an accountant to handle this for you to get you the money that you deserve. The third tax mistake that you could be making is receiving foreign income or gain and not declaring it to HMRC. Before we go into details, please, if you have found any value in this video so far, please subscribe to our channel, and don't forget to hit the like button to send us a signal. And again, share this video with friends and family who may also find this useful. So the third mistake that you could be making is receiving foreign income or gain as a UK resident and not declaring it to HMRC. If you are a UK resident, you are required to declare your worldwide income or gain to HMRC through self-assessment. And you can do this either on a rising basis or remittance basis. It's a choice currently. It will no more be a choice from 6th of April 2025. But currently, it's a choice. You may decide to declare all your worldwide income or gain in the UK as and when they arise in the tax year. Or you may only declare foreign income or gain you remit to the UK on a remittance basis. In either way, you have to declare it to HMRC. If you fail to declare it and HMRC finds out, you will incur a penalty in addition to up to 100% of interest. Don't ever assume HMRC will not know if you have foreign income or gain, because they do. Please declare it to avoid any penalties and to avoid up to 100% of interest on the tax liability. This is another mistake that you may be making. The fourth tax mistake that you may be making is not claiming marriage allowance. If you are married or in civil partnership, if you and your spouse are both basic rate taxpayers, and lastly, if one of you is underutilizing their personal allowance, you can claim what is called marriage allowance. The one that has income below their personal allowance can transfer 10% of their personal allowance to the other spouse to use. And that amount that has been transferred to the other spouse can obtain 20% relief on their tax. This is a lot of money. And again, remember, you can claim for marriage allowance for the current tax year and previous 4 tax years. The maximum relief that the other spouse can obtain in the current tax year is £252. So imagine if you haven't claimed for the current and previous 4 tax years, imagine how much you are losing in cash. For 5 tax years, you could be losing £1,258. You don't want to lose this. This is some of the money that you are losing to the taxman. You are entitled to this amount, and so make use of it. This is a mistake that you're making. You are not claiming what is due to you. Claim it all. This is a tax mistake. The 5th tax mistake that you may be making is not checking your tax code regularly. If you are on a wrong tax code, it may mean you are either overpaying or underpaying tax. If you are overpaying tax, imagine what it's doing to your cash flow. You are just giving the taxman the money that you can use for investments to grow your money. You are giving it for free for the taxman. Even though if you have overpaid taxes, HMRC will always return it to you after the end of the tax year. But you don't want your cash to sit with HMRC. And so you want to check your tax code regularly. On the flip side, if your tax code is wrong and you are underpaying taxes, it means after the end of the tax year, you will get a tax bill from HMRC to pay. You don't want to be hit with a big tax bill. Usually, if you get a big tax bill and you don't have the cash, it means you're going to struggle to pay the tax bill. And so it's essential to check your tax code frequently to ensure it's the correct tax code at every point and you are paying the right amount of tax. You don't want to give your money to the taxman and you don't want to owe tax at the end of the tax year. This is another tax mistake that you may be making. I hope you have found this video useful. Please don't forget to subscribe to our channel. Thank you for watching. See you soon.